By now it appears that the quarantine of 2020 related to the coronavirus is in the early stages of ending, and most state economies are beginning to reopen, and financial markets have somewhat stabilized. So leaving aside the scary nature of this health crisis, I was thinking about how many times since I got my Series 7 license back in 1991 that I've lived through financial crisis like this. I counted 18 of them, from the collapse of the massive hedge fund long-term capital management and the resulting crisis in government bonds back in the early 1990s, to the Asian contagion of 1998, the bursting of the dot-com tech bubble, 9/11, the mortgage and banking crisis of 2008, and the flash crash and Greek riots and Brexits back in 2016, just to name a few. All 18 of these times I watched stock prices plummet to varying degrees. Some went deeper than others, and some took longer than others, but they all featured the same thing: investor fear that for a brief time morphed into outright panic. I can honestly say there's only really one positive memory I can take away from all these experiences, which is that they're amazing opportunities to learn something if you can try to see them objectively. The lessons we learn in crisis moments are not easily forgotten because they're forged in fire and seared in your memory. There's one lesson that seems to be the same every time and reinforces my personal philosophy that equity ownership is really the only investment class worthy of the name. It's one that people always seem to forget every time a crisis ends, so I wanted to mention it this week in hopes that you'll remember this. As I've suggested a bunch of times on these videos, stocks have produced more than 2.5 times the return of bonds over time. But as we all know, stock prices are inherently volatile, and bonds are perceived as much more consistent. So most people think of bonds as a safe way to add stability to their portfolio, and they accept a much lower return so they can achieve the illusion of safety. They can sleep soundly at night, believing that when one of these crisis moments hits, their bonds will protect their portfolio and smooth the ride because bonds are uncorrelated to stocks. The problem is, when it all actually hits the fan in a real financial crisis, investors come to realize the harsh realization that everything is correlated in a crisis. And those bonds that were supposed to protect you from volatility are not working as you planned. Understand that a bond is simply a certificate of debt. When you own a bond, you've loaned money to some entity that's promised to pay you back in the future with interest. Well, that works great when you can be confident that they'll pay you back, like you can with the US government. However, most people don't invest in treasury bonds because they're boring and they offer very low yields. Instead, they invest in funds that own corporate bonds and municipal bonds, which have issuers that are subject to the same financial distresses that company stocks are. In a crisis, no matter what the underlying economic calamity may be, suddenly the company or municipality to whom you loaned your money is also experiencing a serious cash crunch. And it's suddenly not so certain that they'll pay you back like they promised. Sometimes they won't, and the borrower actually will go bankrupt, and that loan certificate will be worth zero. Fear of this happening can and usually does have significant impact on bond prices at a time like this, because bondholders get just as scared as stockholders do and sell their bonds. In fact, during the week of March 23rd this year, when the stock market hit a low point down about 35% from its high, everyone was talking about equity market volatility. Few people noticed that there were high-quality corporate and municipal bonds which were trading at 70 or 80 cents on the dollar at the same time. In 2008, this was even worse. So much for the illusion of safety. Although most of the time, most of those bonds will recover and do just fine, a bond issuer can go bankrupt, while there's really no chance that the S&P 500 could go to zero. So much for the illusion of safety. I think it's much safer to own an asset class that's based on owning an equity share of the growth of a group of companies, which are leveraged to capitalism's ability to regenerate itself after a crisis like this, than one that's based on debt, in which I get paid way less to bear essentially the same risks. But that's just me.